Hey guys, all content discussed is due diligence gathered with aim at better understanding the nature of the current market in anticipation of the greatest squeeze in financial history. Let's dive in. Today I woke up to a pretty shocking piece from Forbes, slamming Gary Gensler for essentially not paying attention to the markets and his relaxed stance when it comes to enforcing policies to protect market participants. Big shout out to Rosalind Layton for her piece, which I will now break down. It begins by saying that Gary Gensler could have more presence while this recession painfully plunges financial markets. It accused Gary Gensler of sitting by while distortions occur, making him an opaque and inconsistent. The SEC is setting up policy to serve insiders and not to serve the rule of law nor enforce it. Gensler demands bewildering disclosures on how financial assets affect the weather. He also develops discriminatory rules without procedure and input. He also rejects constitutional check and balances. He is accused of weaponizing the SEC's war on cryptocurrency by claiming that every digital asset is probably a security. Keep note that the SEC has not even developed forthright policy on cryptocurrency, as Congress has not instructed it to do so, nor have commissioners ever voted on a position. Gary Gensler, however, has urged startups to come in and talk to the SEC about getting registered. This is absolutely bewildering, considering the SEC lawyers continually refuse to comply with court orders to produce evidence on SEC leaders' views, which are material to SEC vs. Ripple Labs, which was a $1.3 billion lawsuit against an enterprise blockchain technology. The judge preceding the case, Sarah Net Byrne, repeatedly ordered documents from the SEC on crypto, eventually blasting the agency for hypocrisy and behavior which suggested that the SEC is adopting its litigation positions to further its desired goals and not out of a faithful allegiance to the law. The SEC's pattern of regulation by enforcement has shattered any and all hope of leadership in financial innovation in cryptocurrency and opportunities for new investors. The SEC's antipathy to tokens go against legal precedents and technological neutrality. Gensler's lawyers have been quoted as saying that if a person buys a token on the secondary markets for speculative purposes, then every one of those tokens is an investment contract in a company that the rest of the holders may never have heard of. The article concludes that the SEC, under Gary Gensler, disrespects Congress and the courts and imperils investors and innovators. Rosalind Layton argues that Gensler should reign now in order to avoid further damage. Now, this was a pretty direct attack against Gary, and it took the angle of a cryptocurrency investor. I do not have any counter-arguments against the points being made, as I too find that Gary's and the SEC's approach towards the cryptocurrency regulation and oversight is tone-deaf and even illegal. I personally think, based on everything that has happened in the past year, that the SEC is trying to build a regulatory framework similar to that which they use to enforce laws on the stock market, and that is a huge problem. The reason for that is that the SEC does not protect retail investors. In fact, they don't always even protect big investors. The way they choose and pick legal fights make them a biased agency that prioritizes which companies are going to be winners and which companies will be allowed to get manipulated into bankruptcy. I made many videos illustrating how the SEC is made up by previous private equity employees, who most likely switch careers as a way to infiltrate the agency and ensure that the status quo is maintained, so that the criminals winning in the game are able to preserve their leverage and remain in power. Given the decades' worth of evidence suggesting the SEC is at best incompetent and at worst complicit in crime itself, I do not find them suitable to be dictating any framework to so-called protect investors engaging in cryptocurrency, especially when Congress itself hasn't even given them any directives to do so. Having said that, I do not think Gary Gensler is all that bad. Yes, he has some seriously misaligned goals and ways of being, but there have been many times where Gensler has taken the fight to big money and stood strong with retail investors. The biggest example of this was when corporate media was looking at the meme stock saga unfold and began pushing the narrative that people sharing their own opinions about stocks should be made illegal because, according to their two-digit IQ logic, it should be considered market manipulation to simply talk about stocks. They perceived any discussion about the potential future of any stock to be considered pumping a stock, and Gary Gensler was brought on interviews and questioned about what the SEC's stance on the matter was. Gary, without hesitation, stood by investors in the First Amendment in the Constitution. He said that he and the SEC agree that people should talk and be enthusiastic about the markets. That was paramount not only to preserving our ability to control our own financial future, but to protect the First Amendment itself, which was attacked and threaded by corporate media networks that had the audacity to question America's most important and sacred amendment. Another instance where Gary Gensler gained brownie points with me was when he and the SEC released the GameStop report. Granted, it did not talk about all the things we wanted to hear, nor was it an extremely detailed account of the events that took place. However, the fact that this report was greenlit to be released was a testament to the transparency Gary Gensler wants to have. The report, bad and omitting of crime as it was, still served as a great document which also did prove many of the assumptions and theories we had at the time. That report was used to corroborate even deeper and more complex analysis that further demonstrate that the MOIS thesis is true. To be straight with you, Gary Gensler should be criticized because the shortcomings of the SEC are infinite at the moment. The level of criminality and gross infestation of corporate private interests now embedded in the system itself is disgusting and extremely dangerous for the future of markets. However, my own take is that I would rather have Gary Gensler than any other in his position. Gary Gensler is open to conversations, even the tough ones where we know he will get grilled. He went on a show with Jon Stewart, a well-known social activist who does not shy away from questioning people on the spot. I would make a bet that any other SEC chair would never ever under any circumstances go on that special and get grilled in front of millions of people, but Gary did, because he understands that being in the position of power he demands transparency. So to that end, I like and prefer Gary Gensler, but to the output being made by the SEC, they get an F from me. Now, moving past the SEC, let's talk about mortgages. The mortgage rates in the United States surged to the highest level since June, which means there is pressure boiling in the housing market as demand continues to fall sharply from its pandemic-era peak. The average 30-year loan rose to 5.55% last week. This is the steepest surge since 2013, by the way. Rates also jumped in the yields for the 10-year treasuries, topping 3% for the first time in a month. Home sellers are being forced to cut their asking price and brokerages are laying off staff left and right. Builders are slowing down on construction starts while simultaneously stepping up incentives to lure customers as inventory piles up. Still, even amid waning demand, there is still reasonable potential for homebuyers on the sidelines to jump back into the market. We know many people decided to sit out while the prices began to skyrocket and have been waiting for a pullback. Now that it's here, perhaps they are trying to wait to catch the bottom before all jumping in on the best discounts. New data came out showing that applications for unemployment insurance fell for the second week, suggesting employers are holding on to workers despite growing economic uncertainty. The initial unemployment claims decreased by 2,000 in the week ending in August 20th. This decline does show that there is still a robust labor demand and that companies are still trying to attract and retain employees. We have been seeing technology companies engage in massive layoffs, even going as far as freezing hiring, which could and should continue in coming months if the Federal Reserve raises interest rates even further to curb demand and tame inflation. If the rates do indeed get increased, the technology sector will not be the only ones cutting staff and we could begin to see jobless claims increase over time. Today, we saw stocks rise and bond yields fall off. Tomorrow at 10 a.m. Washington time will be when Powell will have his speech, so expect him to restate the same points he has been repeating for a while now, saying that he plans to keep tightening monetary policy to fight inflation. We could even see a market rally afterwards as investors and markets decide that everything has been priced in, an overquoted term now used to excuse algorithms pumping markets up without fundamental valid reasons to do so. We talked about the gap in reality between fundamental value of a security and their current prices yesterday. This goes right into that, and if markets do indeed pump after the speech, it will be yet another example of market delusion into everything needing to be bullish. After 2020, investors are spoiled in thinking that markets must always go up no matter how bad the news are because things will be priced in, and their reckoning is looming in. Don't take it from me though, take it from BlackRock, which said they have not yet begun buying the dip. When the world's most powerful corporate, big enough to be America's fourth branch of government, says they aren't buying the discounted shares, it means we have not yet met the bottom and should be strapped in for worsening market conditions, so ignore the media and the influencers on social media telling you to buy like crazy. Nothing significant came from GameStop or AMC. Yesterday reports came out that GameStop will begin paying some of their retail staff with shares and I am awaiting a bit more detail on that end. AMC discourse continues to be extremely toxic as we try to analyze and predict what will happen with ape shares. Aside from that, I want to invite you guys into my Discord. We day trade stocks there and yesterday I let anyone who asked into private channels and all of them were impressed by the alerts they were getting and the money they profited. Come check us out if you have a moment. We even have discussions related to AMC and GameStop as well. Other than that, I hope to see you tomorrow. Enjoy the rest of your day and to the moon.